Shell completely crushed consensus this quarter. Like, they delivered this massive earnings per share beat of $3.52.
Yeah, which totally blew past the $2.83 to $3.23 expectation range.
Exactly. And revenue came in at $94.66 billion. Now, I know that top-line revenue was technically a miss compared to the absolute highest, $108.24 billion street estimates.
Right, but you have to remember, it still represents a massive 45% year-over-year jump.
Oh, absolutely. It easily cleared the lower consensus models. And on the guidance front, full year 2026 cash capex is maintained at $24 to $26 billion.
Though they did note that Q3 production is expected to dip across the board due to, well, heavy portfolio-wide maintenance.
Yeah, we'll get into that. But the market reacted exactly how you'd expect, right? Shares popped on the print, rising 2.28% pre-market and closing up over 3% at $91.03.
A very solid day for the stock.
But, underneath those headline numbers is this completely counterintuitive reality. If you are a retail investor looking at this stock, you have to ask yourself, how does a company lose 31% of the physical production in its flagship business due to geopolitical disruptions?
Right, the Middle East issue.
Yeah, and somehow still walk away with nearly $10 billion in profit.
Well, you don't do it by being a traditional oil and gas company.
No.
I mean, when you synthesize this quarter, you're looking at an absolute masterclass in volatility capture.
Volatility capture.
Exactly. They generated $9.84 billion in adjusted earnings, which is a 4-year high.
Wow.
And more importantly, they printed a staggering $21.4 billion in operating cash flow.
Rob.
And you hit the nail on the head regarding the context. Shell delivered this immense cash generation despite severe operational disruptions in the Middle East.
Right.
It just proves that their integrated model is uniquely positioned right now. They aren't just, pulling commodities out of the ground.
Yes, not at all.
They're using their trading arm to essentially insulate their balance sheet from physical supply shocks.
Yeah, looking at the sheer scale of those trading profits, the best way to understand Shell's current operational model is that it doesn't even look like a traditional energy major anymore.
No, it really doesn't.
It looks like a massive global macro hedge fund that just happens to be attached to physical steel. Like, when we look at that $9.84 billion in adjusted earnings, it feels like Shell's real product right now isn't oil and it isn't natural gas.
Then what is it?
Their primary product is optionality on volatility.
That is exactly the defining characteristic of this specific quarter. The physical steel, the deepwater rigs, the pipelines, the massive LNG terminals, those assets provide the baseline volume, sure.
Right.
But more crucially, they provide proprietary information flow. When geopolitical tensions spike and supply chains fracture, a pure-play exploration and production company just gets the passive benefit of higher benchmark oil prices.
Which is nice, but it's passive.
Exactly. But Shell gets that price bump, plus their trading desk goes to work. Because they actually control the ships and the terminals, they can aggressively optimize routes in real time.
They can essentially arbitrage the regional price dislocations, right?
Oh, absolutely. Buying where it's cheap and instantly rerouting a tanker to where it's desperately needed. And in doing that, they capture these massive outsized margins in the paper markets.
And the immediate question for anyone holding the stock is what management is actually doing with that $21.4 billion mountain of operating cash flow.
And the answer is aggressive capital return.
Highly aggressive. Management announced a new $3 billion share buyback program for Q3, but they didn't stop there. They are also executing an additional $1.2 billion from a previously suspended buyback program.
Yeah, and we should clarify that the suspension from earlier in the year was purely a technical pause.
Oh, right, because of the acquisition.
Exactly. It was required by regulatory rules during their pending acquisition of ARC Resources. They couldn't legally buy back shares during that specific window.
So now that the window is clear, they are just unleashing that pent-up capital right back into the float. To put the scale of this capital return in perspective for you, Shell has now distributed 44% of their total cash flow from operations over the last 12 months.
That is massive.
It is. This marks their 19th consecutive quarter of delivering at least $3 billion in buybacks. And simultaneously, they fortified the balance sheet. Net debt dropped down to $41.8 billion, which brings their gearing ratio down to a very comfortable 19%.
And that gearing ratio is, it's critical to understand if you are modeling out their future dividend safety.
Break that down for us.
Gearing is basically the measure of their financial leverage. It's how much of their operations are funded by debt versus shareholder equity.
Mm-hmm.
Getting net debt down to $41.8 billion, or just $12 billion if you strip out lease liabilities, provides incredible structural resilience.
Right.
It gives management the absolute flexibility to maintain their stated framework of paying out 40% to 50% of cash flows through the entirety of the commodity cycle, even if we see a severe macro downturn tomorrow.
But wait, let's look closer at that payout ratio because, frankly, it might actually be too conservative right now.
You think so?
Well, look at the raw cash generation. Free cash flow hit $17.5 billion this quarter. Debt is safely parked at that 19% gearing level. And a huge chunk of that operating cash flow actually came from a $3.4 billion working capital inflow.
Right, which reversed the massive build we saw back in Q1.
Exactly. So with the balance sheet this clean, shouldn't retail investors be demanding a larger slice of that working capital reversal right now? I mean, a $3 billion baseline buyback almost feels light when you are printing $17.5 billion in free cash.
Well, it is a massive point of debate on the buy side right now, but you really have to view that working capital inflow through the lens of commodity market mechanics.
Okay, how so?
Shell built up $11.2 billion in working capital in Q1. When energy prices gap up wildly at the end of a quarter, an integrated major has to post billions in margin calls for their hedging operations.
Right, and the value of the inventory sitting in their tanks skyrockets.
Exactly. Reversing $3.4 billion of that tied-up cash this quarter is fantastic, but management knows working capital is highly cyclical.
Because if they immediately distribute that entire $3.4 billion cash reversal to shareholders as a special dividend or a mega buyback.
The capital is gone.
Right.
And if commodity prices suddenly gap up again next month, requiring another massive margin call or inventory build just to keep the trading desk operational, management would be forced to fund that working capital requirement with new debt.
Which defeats the whole purpose of keeping gearing low.
Precisely. By maintaining the reliable $3 billion baseline, plus just the $1.2 billion regulatory catch-up, they keep the buyback program exceptionally steady without holding the balance sheet hostage to the, daily whims of the commodity cycle.
Okay, that makes sense from a risk management perspective, but I want to pivot to the segment breakdown because this is where the underlying math of the quarter starts to look completely disconnected from the physical reality.
Oh, absolutely.
Because Shell achieved record margins, but their actual physical production volumes took a massive hit in a few core areas.
Yeah, the math only works because of the trading optimization and downstream refining performance. If we look impartially at the impact of the ongoing conflict in the Middle East, it resulted in Shell's Pearl Gas Liquids facility in Qatar being taken completely offline.
Which is a huge deal.
To give you some context on Pearl, it is a gargantuan asset. A gas-to-liquids, or GTL facility, takes raw natural gas and synthetically converts it into high-value liquid fuels, like ultra-clean diesel.
So taking an asset of that scale offline sent shockwaves through their production numbers. Integrated gas production cratered by 31% sequentially, dropping to 631,000 barrels of oil equivalent per day.
And LNG liquefaction volumes also slipped 2% down to 7.73 million metric tons.
Which is wild because in any normal quarter for any normal energy company, a 31% volume drop in your absolute most profitable flagship segment would be an unmitigated disaster on the earnings call.
Oh, it would usually trigger a massive sell-off.
Yeah.
But realize gas prices jumped. They rose from $6.90 to $8.30 per thousand cubic feet.
So the physical volume lost, like the actual molecules of gas they couldn't produce.
Was completely masked.
Wow.
Yeah, masked by the trading desk, leveraging derivatives and rerouting physical cargoes to capture those higher regional prices.
And that operational outperformance wasn't just limited to the gas trading division. Looking at upstream and downstream, the execution was practically flawless.
Yeah.
Overall, upstream production did edge down slightly to 1.824 million barrels of oil equivalent per day, largely due to some planned maintenance, though it is worth noting they saw record output from their deepwater assets in Brazil.
Which is a great bright spot.
But the undeniable star of the quarter, the thing really driving these massive cash flows, was the downstream and refining segment.
Oh, the refining numbers are genuinely historic. They ran their global refinery network at a blisteringly hot 102% utilization rate.
Wait, stop right there, because if you aren't familiar with heavy industry, running at 102% utilization sounds physically impossible. Like, how do you run steel past 100%?
Right, it sounds crazy. But nameplate capacity, which is the 100% mark, is basically just a conservative engineering estimate of what a refinery can process sustainably over a long period.
Assuming standard maintenance schedules and normal crude blends, right?
Exactly. When margins are incredibly lucrative, engineers can delay certain non-critical maintenance and push throughput past that nameplate rating. Shell optimized their refinery yields specifically to capture higher value middle distillates,
Which are your diesel and jet fuels, right?
which are currently experiencing structural global shortages. That strategic pivot pushed their global indicative refining margins up from $17 a barrel in Q1 to a staggering $20 to $24 a barrel this quarter.
And we cannot ignore chemicals in this downstream discussion. Indicative chemical margins nearly doubled. They surged from $139 per ton to between $240 and $270 per ton.
Incredible jump.
It wasn't just a slight beat, it was their strongest chemicals performance in over 5 years, largely driven by lower feedstock costs against steady industrial demand.
It was essentially a perfect storm of margin expansion across every single downstream unit.
I mean, I see the numbers, and the cash flow is real, but I have to point out the underlying fragility here.
Okay, what do you mean?
Well, if 102% refinery utilization is the absolute physical ceiling, because you literally cannot run high-pressure steel and chemical units much harder than that safely without risking a catastrophic failure.
Great.
And the trading desk essentially carried the upstream division by capitalizing on conflict-driven commodity spikes. Isn't this quarter's earnings quality highly unrepeatable once the macro environment stabilizes?
The exact question institutional analysts are raising right now. Morningstar actually put out a note explicitly stating that a strong trading quarter caused by geopolitical conflict is not evidence of a durable economic moat.
It's just a windfall.
Exactly, it is a windfall. You cannot model 102% refinery utilization into your spreadsheets in perpetuity. Steel requires downtime for maintenance, which, we are already seeing reflected in their Q3 guidance.
But Shell's counter-argument on the earnings call essentially boils down to volatility is the new normal.
Right. Management's thesis is that global energy markets are now structurally tight and permanently fractured by geopolitical realignments. Because of underinvestment in new supply over the last decade, any minor disruption causes massive price swings.
So if that thesis holds true, Shell's ability to capture outsized margins is highly repeatable.
Yeah, even if the specific source of the volatility shifts from the Middle East one quarter to Europe the next.
But capitalizing on macro chaos with your trading desk isn't a permanent baseline business strategy. You still need physical assets that print cash in a quiet market.
Right, you need a solid foundation.
And that brings us directly to the structural reshaping of the business, because management is ruthlessly gutting their legacy portfolio to tighten the ship for the long term. Since 2022, they have achieved $5.8 billion in structural cost reductions.
And they delivered about $700 million of that in the first half of 2026 alone. The divestiture list tells you everything you need to know about their new capital discipline. They sold Jiffy Lube in the USA for $1.3 billion. They are offloading SPRNG Energy in India, they sold their South Africa marketing business, and they divested the Na Kika deepwater assets in the Gulf of Mexico.
They are pruning anything that doesn't clear an elevated, very strict hurdle rate for returns.
But they aren't just shrinking the company. They are actively rotating that capital.
Which brings us to the pending $13.6 billion acquisition of ARC Resources. This is a massive step.
Super.
Once they clear regulatory approval, which they are guiding for Q3, this asset in Canada's Montney Basin is going to add roughly 370,000 barrels of oil equivalent per day. Given their current upstream baseline of 1.8 million, that is a massive injection of volume.
It really is.
And more importantly, it permanently boosts Shell's projected production compound annual growth rate to 4% all the way through 2030.
Yeah, the Montney Basin is known for incredibly prolific, low-cost natural gas. That ARC transaction fundamentally alters Shell's medium-term volume trajectory. For years, the major criticism of Shell from traditional energy investors was that their core oil and gas volumes were in terminal decline as they invested heavily in green energy.
Right.
Adding 370,000 BOE of high-quality Canadian natural gas signals a fierce commitment to scaling their core hydrocarbon business. Specifically, that Montney gas is going to directly feed their massive LNG Canada export terminal project.
It's a textbook capital rotation, but the specific optics of it are jarring. Think about it like a real estate investor selling a trendy, culturally celebrated, but high-maintenance downtown condo, which is SPRNG Energy, a major renewables business, and using that exact capital to buy a boring, high-yielding industrial warehouse, which is Canadian natural gas.
That's a great way to put it.
But by dumping Indian renewables to double down on fossil fuels, isn't Shell's leadership quietly pivoting away from the energy transition entirely?
I wouldn't call it a quiet pivot, honestly. It is a very loud, highly pragmatic re-rating of capital allocation.
Okay, loud how?
The mandate from the new CEO has been crystal clear since day one. Financial returns matter more than thematic ESG narratives. The reality is that renewable power projects often face intense margin compression, brutal supply chain bottlenecks, and significantly lower baseline returns compared to upstream oil and gas.
Sure.
Shell is not abandoning the energy transition, but they are absolutely refusing to subsidize low-return green power projects with high-return fossil fuel cash flows.
So they are acting like fiduciaries, allocating capital strictly where they have a distinct competitive advantage.
Exactly. Their bet is that natural gas, specifically liquefied natural gas or LNG, is the indispensable bridge fuel for the global economy for the next 2 decades. They are positioning themselves to dominate that specific vertical, rather than trying to compete in low-margin solar and wind generation.
Which grounds us perfectly to look at the immediate risks threatening this financial momentum as we head into Q3. Because the forward guidance is definitely softening. Shell explicitly expects those incredible chemical spreads we just talked about to contract.
Yeah.
Upstream production is facing heavy planned maintenance across the portfolio, with guidance lowering significantly to between 1.68 and 1.88 million BOE. Integrated gas volumes are also guided lower, expected to land between 570,000 and 630,000 BOE.
Well, that Q3 guidance simply reflects the physical reality of running your downstream and upstream assets at maximum capacity in Q2. When you run refineries at 102%, you have to take the maintenance downtime eventually, and Q3 is when the bill comes due.
Right.
But the immediate quarterly dips aren't the real concern. The longer-term uncertainty is what you really need to model. We mentioned the Pearl GTL facility in Qatar earlier. Shell confirmed on the call that one entire train at that facility will remain completely offline until the end of Q1 2027.
Wow, so that is a prolonged multi-year impairment to their absolute highest margin segment. And zooming out even further, there are broader fundamental risks tied directly to this massive capital rotation into LNG. Shell's entire corporate thesis right now relies on natural gas being the necessary bridge fuel to back up intermittent renewable grids.
Right.
But what happens if we see rapid, exponential advancements in grid-scale battery storage technology? If batteries can cheaply solve the intermittency issues of solar and wind, that could severely threaten global LNG demand long before Shell's 2030 projections play out.
And that is the existential bear case for Shell. If renewable energy scales faster than expected and battery storage solves baseline electrical load requirements without needing natural gas peaking plants,
Right.
then Shell's massive multi-billion-dollar capital deployment into projects like LNG Canada and the Air-Sea Resources acquisition becomes a massive liability. They could literally be left holding deeply stranded assets.
So let's bring it back to the immediate term and stress test this balance sheet. We've praised their 19% gearing ratio. But if oil prices soften materially in the back half of the year, dropping down into the mid-60s, and that remaining Q1 working capital fails to reverse into actual cash inflows, how credible is their strict 40% to 50% payout framework going into next year?
It remains highly credible precisely because they spent this quarter getting that gearing down to 19%.
I see.
If crude oil drops to $65 a barrel, their operating cash flow will absolutely take a material hit. But because their net debt is sitting at just $41.8 billion, they have massive balance sheet capacity. They could literally float the $3 billion quarterly buyback program by taking on short-term commercial paper without risking their AA credit metrics.
So they've buffered themselves?
Management has engineered this balance sheet specifically to protect the dividend and the buyback from mid-cycle commodity volatility. They are prioritizing shareholder returns above all else.
Which brings us to a massive structural conundrum that wasn't explicitly debated on the earnings call, but is absolutely dominating the equity research notes following the print.
Right.
Shell's current transition strategy sits in this incredibly awkward middle ground. By aggressively funding LNG and oil, it fails to fully satisfy the pure-play hydrocarbon investors who are demanding maximum volume growth.
Yes.
But simultaneously, by holding on to European renewable assets and setting emissions targets, they're completely alienating ESG-mandated funds who want to see a rapid pivot away from fossil fuels.
It is the absolute definition of strategic limbo. They are generating world-class, nearly $10 billion quarterly cash flows, yet their stock trades at a persistent, frustrating discount compared to their more focused U.S. peers like Exxon and Chevron.
The market is effectively penalizing Shell for the complexity of their integrated model, right?
And the political realities of their European domicile. Investors just don't know exactly what to price them as.
And here is the provocative thought I want to leave you with today. If this strategic limbo continues to result in a depressed valuation, despite printing $21 billion in operating cash flow, could it eventually force activist investors to demand a total breakup of Shell?
It's a huge possibility.
I mean, if the discount doesn't close, we could very well see a future where aggressive funds force management to spin off the legacy oil assets from the integrated gas and renewables businesses simply to unlock the massive sum-of-the-parts value hidden inside this conglomerate.
It is the ultimate question for any long-term shareholder right now. Management is desperately trying to prove through quarters like this that the integrated model, the macro hedge fund attached to the physical steel, creates a compounding value that a broken-up entity could never match.
But if that valuation gap persists, the pressure from Wall Street to split the company apart will only intensify. Make sure you follow the show for daily, no-nonsense earnings coverage, because whether Shell remains an integrated global giant or eventually gets chopped up into pieces by activist investors, one thing is clear: after this quarter, their core product is going to remain optionality on volatility.